Everybody that I know of loves choices. What they hate are decisions. I always talk about retirement like a cheesecake factory. And if you've never been, the Britannica Encyclopedia is very similar to their menu. You've got more choices than you can possibly ever come away with a good conclusion. And you feel great until the waiter or the waitress walks up and all of a sudden you have to make that decision. Ladies and gentlemen, that's how people feel when it comes time to decide, when do you take money out of an IRA? When do you take money out of a 401k? When do you take Social Security? And the myriad of other decisions that you have to make when you go into retirement, or what we like to call your life after work. Adam and I are going to spend some time today and share with you some concepts. We call it Retirement V for Victory. That's the idea, having a successful retirement, a Retirement V for Victory. We're going to talk to you a little bit about Social Security and when indeed you should pull the money out of those accounts and in what order. Well, good morning and welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Adam Harter.
And we are going to talk to you today about one of my favorite conversations. We call it Retirement V for Victory. You know, in 1997, we started the Financial Enhancement Group, and the website, by the way, has been called, since then, Your Life After Work. Distribution planning is what we have done for the entire creation of the Financial Enhancement Group for 23 years, going on 24 years. This is where our focus has been because it is the most important part. It doesn't matter what the score is at halftime. It doesn't matter what the score is at the third quarter. It matters what happens at the end of the game, right? The fourth quarter, distribution, how you actually go about using the money. Retirement V for Victory. We're ready to talk about it. So Adam, let's hit this first in the very broadest sense, the big brush. What's the concept?
So the concept is that we'll start with, usually what we're brought is the idea that retirement, Social Security is meant to be taken early and investments are meant to be delayed. And we spend a whole lot of our time shifting that paradigm. And in doing so, that inevitably causes the investment portfolio to decline in value because we're pulling essentially what would be Social Security income out of the portfolio. So that causes, if we're charting our investments, most likely we're going to see that decline on the chart. And after decades of seeing it go up and accumulate, it's very difficult and emotionally to do. So we're going to draw that down for a period. However, we know that it's short-lived and eventually Social Security income will kick in and we can re-enter a period of watching that portfolio reclaim prior values.
So let me get this straight because I want you guys, and this is going to be a little, I don't know, cynical is not the right way. I just want to make sure you get the picture. See, the Financial Enhancement Group has some unique beliefs. And it's, you know, Adam and I essentially built the company with Don Hodson. We're allowed to have unique beliefs. We own it. We run it. We have a few other partners. But, you know, the two largest shareholders are on this show with you today, and we have some very definite beliefs. So let me get this straight. What I just heard you say was that we encourage people in the right setting. It's not right for everybody, but in the right setting, we're going to encourage people to take money out of their accounts and delay Social Security. Is that what I heard?
Oh, absolutely.
Now let me get this. Let me restate this because it's important to understand. We get paid at the Financial Enhancement Group to manage money, right? So when accounts go down in value, Adam, what happens to our income?
Oh, it goes down. Yeah.
Now wait a minute. We're a business, and yet we encourage people to take money out of accounts, knowing that it's going to drive our income down.
Yep.
Okay. That makes no sense at all to people that are hearing this for the first time. But it makes every bit of sense when we go to bed at night and sleep like babies, right? We are in the business of managing money. Adam and I will squeeze every single nickel to get as much safe return, much managed return out of that as we possibly can, based on what your objectives are and what it is you're trying to accomplish in life. We will do that. But one of our things is to help you understand your financial journey and to be able to enjoy it, to actually be able to use your money. And I've had people look at me in a meeting and go, why in the world would you encourage me to delay Social Security and to take money out of my account now? And the answer is because for most of you, not all of you, but for most of you, that is the right answer for you. And we take this fiduciary part very, very seriously. Our job is to treat your money as if it were our money and we were in the same situation, and we will not violate that, even if it does appear short term to be not in our best interest. We're here for the long haul. It's why we've had relationships as long as we have. We will do for you what we would do for ourselves. And believe me, that for most people, the delaying of Social Security is the right answer. So let's talk about Social Security real quickly. So let's assume you have two silos. We'll think about it as a farm operation, right? Most people make Social Security decisions thinking about just it. Just it. I call it silo thinking. I want you to think about a farm operation. So let's pretend like you have two different silos. One's got the beans, one's got the corn. In this case, one is your opportunity for Social Security, and one is the money that you've got in a 401k or IRAs. So Adam, what is the decision on Social Security? What does it mean when I take Social Security at age 62?
Well, what it means is that you are foregoing the ability for it to continue to increase. The longer you delay that, the more bountiful the withdrawal will be, or the more bountiful the benefit would be.
So every year we take it before full retirement age, we lose 6% per year. And it is month to month, by the way. They do the math that way, right? So it's 0.5%. So it's 6% for every year you take it early. And then after 67, waiting up to age 70, that's as long as you can wait now, you actually grow by 8% a year. Adam, how much money do you suppose we could move tomorrow if we could guarantee people an 8% income increase?
Oh, we couldn't handle it.
Yep, it's well above a B, and you're getting into you're getting into probably 10 digits pretty quickly if you want to know the truth, if you could handle it, right? I mean, that's an amazing opportunity. So assuming your health is in good order, you have other assets, and you have any understanding of the tax code at all, typically the delaying of this is great. So here's a common thing that I get. We take care of people that are in their 50s, so they're nowhere near retirement yet. They're nowhere near Social Security yet, and they come in and they go, Joe, I'm looking here at my statement, right? And life's been pretty good here since 08 and 09. And we've had many people longer than that. The average return, which we believe in a financial journey. They know what they've averaged on a year-to-year basis, and they've had some great years. The market's been great, right? How in the world do I justify, as the family, taking money out of my account that's been doing so well in exchange for leaving it in Social Security, which we all know the government's broke, right? And I may die.
Yeah.
Right?
It makes all the logical sense in the world. And the sad truth here is the math and the decision-making process is way more complicated than we can do. I love back-of-the-envelope calculations. I like to simplify things, and I think it gets the job done most of the time. This is more important than that. There are too many variables at stake, and you just can't look at it that simply. And I would say that we have taken a balance of risks to achieve those returns. Of course, everybody's different, but the ranges you indicate are accurate. The last 12 years or so have been wonderful. However, that 8% is guaranteed.
There is a difference.
It is absolutely guaranteed. And it's looking out the windshield, not the rear view. That's also something you don't have the ability to do.
Right. So to rephrase that, when we're talking about previous returns, right, and you always hear people who sell things say past performance is not indicative of future results. Well, they're right. Right? Just because the market did this doesn't mean it's going to do something different, good, bad, or indifferent, into the future. It is a rear view mirror. Here's where we've been. That does not necessarily tell us where we are going, right? Where Social Security, on the other hand, does. And I actually read some of Biden's comments on Social Security and Medicare earlier today. I try to stay away from conversations that have not been passed. It's just one of my rules. I don't ever read about what might happen, but it is my job to pay attention to trends. And I will tell you, based on the demographics, people who are on Social Security are getting ready for it. Vote, right? And it's a political nightmare to change Social Security in the short term, right? You may have them change something for my age at 54, certainly Adam's age at younger, but it's not something that you're going to see wholesale changed in the next 3 to 5 years for people that are walking into Social Security. So I think that is a very, very important conversation in terms of where you are. Now, there's a lot of stuff that goes with that, right? The health, what those other assets are, what your tax rate is today, what you think it's going to be in the future, inheritances. There's a bunch to it.
There's a bunch to it, and those variables go at play in terms of what can cause Social Security to be extended in its life frame, and what we really lose in the calculation are some of the optionality. That's where it gets. There's optionality, and especially if you're married and one of you dies and the other one steps into the higher benefit. There's optionality in that you have to incorporate.
Yeah. One of the things, we're blessed to take care of families in 31 states. Now, the lion's share of people that we take care of are actually here in good old Indiana, right? But we do have people in California and Texas and Florida and all over the place. And so California people pay no attention because this may not be true. But I remember as a young person, years and years and years ago, they told me the biggest decision that I would ever make would be buying my home, right? I've got a nice house. We're blessed and I love my house, but I will flat out assure you that the value of my house is nowhere in comparison the value of the decision between me getting Social Security right between Barb and I is what the value is of my house. So let me say this again, for an average or above class middle income, especially dinks, dual income earners, right? The kids are out of the house. Right? So you got dual income earning people at an above average income, not rich, not what we would even call affluent. The difference between taking Social Security correctly and incorrectly can be as much as $500,000, and we can prove it. It's a very, very simple mathematical computation. So what we've learned with Social Security, and I love Adam's expression of the back of the envelope, and he's really good at those calculations, but when you look at Social Security, if you agree to die on time, 84 and a half, if you have no other assets, if you believe that the tax rate won't change, right? And if you believe there will be no cost of living allowance on Social Security, it makes no difference when you take Social Security. You can take it at 62, 65, 67, or age 70. It's absolutely indifferent as long as you comply, and at 84 and a half, you agree to die, right? And nothing else changed. Now, if that's your case, then, God bless, we wish you luck, right? There's a lot of unknowns. There's a lot of things that have to change. And one of the biggest parts of financial planning and doing it right is understanding how to offer that flexibility, how to be able to take care of things coming up that you didn't even see coming. Adam and I like to tell people when it comes to investing, we have to take care of what could have happened, not just what did happen. Right? What could have happened, not just what did happen. It's always easy to look in the rearview mirror and go, you should have thrown that pass, the Monday night quarterbacks, right? After the Sunday games. This is different, folks. You got to get it right. Give us a call at 800-928-4001 or go to yourlifeafterwork.com. Get signed up for a Next Steps meeting.